We've been big on financial transparency ever since we started our social media pages. And today, I'll be taking that one step further. I'll be going through my £110,000 portfolio of investments, split across two investment accounts that I have. Roughly £40,000 sits in my Vanguard pension, and I have around £70,000 in my stocks and shares ISA on Trading 212. Plus, I'll be showing you every single investment that I have in these accounts and talking about how I built them to the point that they're at today. I also lost my voice a few days ago, so sorry if I'm sounding a bit rough. Okay, I'll start with my pension, and more specifically, my self-invested personal pension, or SIP, that I have with Vanguard. Wow, that is going. This is just another type of retirement account, such as the workplace pension that most people will have in the UK automatically. And it helps me to build a nice pot of money for when I retire. This is how it's looking right now, and there are two big questions that would jump out if I were you. One, why doesn't it start from zero? And two, what's with that massive straight line up about halfway through? To answer that first question, it doesn't start from zero because it didn't start from zero. When I quit my job to become self-employed full-time, I still had a pension with my employer and the company they used for their workplace pension. I could have left it there, but I could see myself forgetting about it in 30 or 40 years' time. So I simply transferred the money from my workplace pension to my Vanguard self-invested personal pension, which is why I started with over £10,000 in the account. Now the next question. Why the big spike? Well, first, it's important to point out one of the big benefits of pension contributions. They come with tax relief. For example, when you contribute to your workplace pension, you add money, usually, to your pension before any tax is deducted. Some pension schemes are a bit different, but in general that's what happens. It comes from your income before tax. And it also lowers your taxable income. And that's really important. Let's say your salary is £55,000, for example. Anything you earn above £50,270 is taxed at 40% because it's in the higher rate tax band. But if you're comfortable enough living off, say, a £50,000 salary, you could just contribute an additional £5,000 to your workplace pension. It would be contributed to your pension before tax and also lower your annual taxable income. So in this case, it would bring your taxable income below that higher rate threshold. And it would save you just under £2,000 in tax whilst helping you to plan for retirement. This is particularly good for anyone earning just over £100,000 because you effectively pay 60% tax on anything you earn between 100 and 125k. But that point is probably for another video. My point now is that pension contributions are a great way of saving for retirement whilst lowering your taxable income. And that explains the big straight line up, because in September 2024, I contributed £10,000 to my pension directly from my company. The business had a great year that year, and there was a substantial amount of excess cash. Neither myself nor Andrea needed to pay ourselves any more, so we decided it would be a great tax-efficient way to boost our pensions, and we each contributed a big lump sum. We also now contribute quite a lot to our pensions through our business. Currently, it's £1,500 a month because it makes sense for us to do this while we can, so we don't end up having to worry too much about our pensions 20 years down the line. But what about the investments in my pension account? Honestly, I'd kind of forgotten about this, but I have 4 different funds that are all invested in stocks. The biggest one by far is the FTSE Global All Cap Index Fund. This invests in thousands of small, medium and large companies around the globe, and it's where my monthly investments go. To be honest, I don't know why I bother with the others. There's the FTSE All World UCITS ETF, which invests in thousands of medium and large companies around the world, and the Global Small Cap Index Fund, which invests in thousands of small companies across the world. So basically, these two combined are doing the exact same job as the FTSE Global All Cap Index Fund, making them kind of pointless. Maybe one day I'll sell them and just pop the proceeds into that All Cap Index Fund. And then I have less than 10% in the ESG Screened Developed World All Cap Equity Index Fund. Pretty sure this was one thing I opted for when I made that initial transfer from my workplace pension. And again, I'm not too sure why. Despite my pension being quite simple, I still think that it's overcomplicated. So I do actually plan to consolidate everything into that FTSE Global All Cap Index Fund. I guess this shows how hands-off my approach is when it comes to my pension. Very much set and forget. Maybe a little bit too much forgetting. So that's my £40,000 Vanguard pension account, which is very hands-off. But now let's move on to an account that I pay far more attention to. My £70,000 Stocks and Shares ISA on Trading 212. Now, like a pension, a Stocks and Shares ISA does come with some tax benefits, but those benefits are different. In a Stocks and Shares ISA, your contributions are made after tax, but you don't have to pay tax on any gains or dividends made on your investments within a Stocks and Shares ISA. And most importantly, you can withdraw your money whenever you like, whereas a pension is only accessible from the age of 55. And that's going to rise to 57 in April 2028. And honestly, who knows what age that will be when I start to approach retirement. So despite pensions generally offering better tax advantages, I put a lot of importance on the flexibility offered by a Stocks and Shares ISA. Over the years, I've built up my Stocks and Shares ISA by regularly contributing to it. And at the time of recording, it's worth about £71,500, including a total profit of £17,500, meaning about £54,000 has come from my personal contributions over the last 5.5 years. And over that time, I have invested every single month after getting paid, with some additional top-ups thanks to things like annual bonuses, and also some smaller mid-month top-ups when I was able to. Now, let's go through my investments, and broadly speaking, I'll go from the largest to the smallest. 26 is quite a few investments to go through, so I've split them up into a few categories. We'll start with my largest investment, which is the SPDR MSCI All Country World ETF, ticker symbol ACWI. This is just another global ETF that invests in thousands of medium and large companies from all across the world. Now, you can see that I'm currently making a small loss on it. That's because I'd previously invested in the Invesco FTSE All World ETF and then made the switch, which effectively resets the profit to zero. This makes up about 22-23% of my portfolio and is one part of my global pie. The other part is the iShares MSCI World Small Cap ETF, ticker symbol WLDS, and this makes up 2% of my portfolio and 8% of my global pie, with that SPDR fund making up the remaining 92%. This pie is basically my way of trying to replicate the FTSE Global All Cap Index Fund inside my pension, having a single hands-off investment that spreads my money across thousands of companies of all shapes and sizes from all across the globe. It's meant to be the solid foundation of my Stocks and Shares ISA, making up about 25% of my portfolio, adding a bit of stability compared to my individual stocks, which can be a bit of a roller coaster. And I'll start by looking at my first category of individual stocks, the Big Five. These 5 stocks tend to always be the biggest holdings in my portfolio, mostly because 1, they have performed very well, and 2, I've held them for a long time. They are US public safety leader Axon Enterprise, accounting for 8.5% of my portfolio, digital advertising company The Trade Desk, accounting for 7%, Latin American e-commerce and fintech giant Mercado Libre, accounting for 7%, cybersecurity leader CrowdStrike, accounting for 6%, and Dutch payments platform Adyen, also accounting for 6%. At the time of recording, these 5 companies account for over 35% of my portfolio. That is a significant amount, and something I'm very happy about, because I truly believe that these are some of the best businesses around, with huge potential to keep growing in the future. They have already been hugely successful investments. You can see that Mercado Libre and CrowdStrike have already more than doubled, and Axon has grown by over 4 times in value. That is despite the fact that I regularly add to my investments over time, and this tends to increase my average price, which is what that percentage return is based on. But yeah, I'm very happy with these 5 investments, and I expect them to continue being the 5 largest investments in my portfolio, unless some others can join the party. Which leads me quite nicely to the next category, which is the best of the rest. These are some more brilliant businesses that make up a smaller part of my portfolio than those big five. But I think they all have the potential to become some of the largest holdings in my portfolio. We've got e-commerce and cloud computing giant Amazon, making up 4.5% of my portfolio. Language learning app Duolingo, also around 4.5%. E-commerce platform Shopify makes up about 4%. And the parent company of Google and YouTube, Alphabet, makes up about 3%. Overall, this small group accounts for just over 15% of my stocks and shares ISA. And I think Duolingo at the minute has to be the pick of the bunch based on performance. I only started investing in it last August, and my investment has already grown by over 150%. Not bad for a little language learning app. And I'll be honest, this exercise in going through this is making me kind of happy. Sure, I do have a lot of investments in my stocks and shares ISA, and sometimes I worry that I don't have enough in the companies that I believe are the best around. But so far, we've covered my global index funds, the top 5 companies that I absolutely love, and another 4 companies that I really like. And by doing that, we've actually covered 75% of the value of my portfolio. So I'm actually quite happy. Now, you've probably noticed that this has gone effectively in size order based on how big a percentage they are of my portfolio. But I skipped Airbnb. That's because it goes into my next category, which is investments that are just chugging along. You know, ones that I'm mostly pleased with, but that haven't set the world on fire for one reason or another. Maybe I've not invested in them for long enough. Maybe because some investments can go on for years and years before rewarding shareholders. Or maybe because they won't end up being good investments. I guess only time will tell. Now, we've got quite a few in this category. There's short-term holiday rental business Airbnb, making up 3% of my portfolio. Dutch semiconductor equipment manufacturer ASML, making up 2.5%. The UK book publisher behind Harry Potter and A Court of Thorns and Roses, Bloomsbury Publishing, making up 2.5%. Cybersecurity firm Zscaler, making up 2.4%. Digital payments platform PayPal, making up 2%. UK specialty chemicals manufacturer Croda International, making up 1.8%. US cloud data platform Snowflake, also making up 1.8%. Cloud monitoring and observability company Datadog, making up 1.7%. And a brand new investment, Brazilian digital bank New Holdings, making up 1.3%. Honestly, there's a lot of investments here that I still remain very optimistic about for the future. And together, they make up about 17% of my portfolio, and I'm excited to see what they can do. I feel like there's also much more of a mix of companies here. You've got high-flying tech stocks like Snowflake and Zscaler. You've got a fast-growing Brazilian fintech in Nubank, alongside a not-so-fast-growing value-style investment in PayPal, and a British book publisher and a British specialty chemicals manufacturer. So a nicer bit of diversification. Finally, we'll head to the bucket of shame. Investments that have just disappointed me so far. Not just in terms of stock performance, but in terms of business performance. Although sadly, the stock performance does tend to follow the business performance, so that has been equally disappointing. This bucket includes German meal kit delivery company and the savior of our mealtimes, HelloFresh, accounting for 1.5% of my portfolio. US functional energy drink brand Celsius, making up 1.2%. US fertility benefits platform Progeny, also making up 1.2%. Luxury fashion giant LVMH, making up 1%. And small ad tech company Pubmatic, accounting for 0.6%. Thankfully, these not so great investments account for less than 5% of my portfolio. Admittedly, it's kind of because they've shrunk in value, but still, clearly they aren't businesses that I've completely given up on just yet, but they're certainly not my favorite. The final category is Latch. Just Latch. Some rubbish microcap I invested in, I don't know, a few years back, whose shares got delisted, meaning it doesn't trade on the stock market anymore. So I can't really sell my shares, and it's just been stuck there for years, haunting me, and I can't get rid of it. But I guess it's a useful reminder of what happens when you make stupid decisions. In hindsight, maybe I should have gone in reverse order, so I would have ended this video on the highs of my most successful investments rather than Latch. But to be honest, those mistakes have made me a much better investor today, even if they did end up costing me over £10,000 when I first started. And I don't really want anyone else to have to learn how to start investing the hard way. That's part of the reason why myself and Andreea launched our 6-week investing roadmap, I think almost 2 years ago now. It's designed to help you start your investing journey in a much better way than we did. I'll pop some details in the description of this video down below. Or you can simply head to our website www.stocksandsavings.com to find out more details. We only run it 4 or 5 times a year, and sign-ups are currently open for just a few more days. So if you want to join over 2,000 previous students, head to that link and take the next step on your investing journey with confidence. And there you have it. That's exactly what's in my £110,000 portfolio of investments. I'd seen a few comments asking for a full portfolio breakdown, so I hope you found this interesting and you won't judge me too much for having latch. Feel free to pop any questions down in the comments below, because I like any excuse to talk about these investments. And don't forget to subscribe to this channel if you're interested in seeing how this portfolio evolves over time, especially as my next video will be all about the investments I bought in June, hopefully with a voice that's working a bit better. Thank you so much for watching, and I'll see you next time.